In this presentation, we will take a look at student loan interest deduction. This will be a longer presentation. If you would like to jump to relevant points within it, take a look at the description below where we will have links to relevant points as well as descriptions about them. We'll talk about the student loan interest deduction. We'll give examples of the student loan interest deduction and how we would report it on the tax forms, including examples of the actual form 1040 and the input into the actual form 1040, as well as Schedule 1, a new form for 2018 that will be necessary for reporting the student loan interest. We'll also talk about restrictions on the student loan interest, things like adjusted gross income limitations, as well as the amount that can be deducted for the student loans. We'll actually provide examples for them so we can see them with examples within the tax software. This information can be found or is based on Publication 970, Tax Benefits for Education. In this presentation, we will discuss the question of, can you claim the student loan interest deduction? This information can be found in Publication 970. Can you claim the deduction? Generally, you can claim the deduction if all the following requirements are met. First requirement, your filing status is any status except married filing separately. Like many credits, this one is restricted for married filing separate, and this is going to be my rationale of why the restriction happens. If the IRS was to allow people to file either married filing joint or married filing separate and then have the different benefits that could be there for different types of credits, they're afraid that there could be abuse of the system. So therefore, when we are married, we have the restrictions of how we're going to file. So the normal single or head of household filing statuses that we could have possibly when not married are not typically there when we are married. And the only options we typically have when married then is to file married filing joint, which would be the way we would be expected to file by the IRS, or married filing separate, but we lose a lot of benefits if we file married filing separately. So just be aware of that. Next item. No one else is claiming you as a dependent on his or her tax return. So you're not being claimed as a dependent on another tax return. You are legally obligated to pay interest on a qualified student loan. So we're talking about the student loan interest. So you have to be legally required to pay the interest on the student loan. You paid interest on a qualified student loan, meaning you actually paid the interest on the student loan. So it's not the requirement was there and you fulfilled the requirement by actually making the payment. Remember that we're more on kind of like a cash basis method most of the time, as in with regards to this payment as well. Back to the text. Claiming you as a dependent. Another taxpayer is claiming you as a dependent if he or she lists your name and other required information on page 1 of his or her Form 1040 or Form 1040NR line 7. So if we take a look at our test tax return, our test 1040, then of course if someone is claiming anybody else here under the dependents line, then they would be a dependent. So if someone else was claiming us as a dependent on their tax return, in essence using our social security number on their tax return, then it's quite possible that we would not then be able to file our own tax return and claim this credit or this deduction for interest payments. Let's take a look at an example. Example 1. During 2018, Josh paid $600 interest on his qualified student loan. Only he is legally obligated to make the payment. No one claimed Josh as a dependent for 2018. Assuming all other requirements are met, Josh can deduct the $600 of interest he paid on his 2018 Form 1040. Let's just take a look at an example in our test 1040. We have the simple single individual. It's not named Josh here. We're just going to use a similar type of example, however. If we scroll down, we've got the income. We're saying income is $30,000. Total income then $30,000. And the adjusted gross income, what? It's $29,400. Why is it $29,400? Because there is an adjustment. We made that on Schedule 1. If we go to Schedule 1, then this is a new schedule from 2018. Scrolling down, we'll see on line 33, we have the student loan interest deduction. So that's where it goes, student loan interest deduction. We have the nice little worksheet here, which is going to be the student loan interest worksheet. And in essence, we have the $600. We'll take a look at the worksheet at a later time. There's the $600, which then pulls over to the 1040. Scrolling through the 1040, you can't actually see it on the 1040 because they tried to minimize. I think they try to take as many lines out of the 1040 as possible. So we have the 30,000, and then it's reduced by those items on Schedule 1 to the 29,400, which is a benefit because that's going to lower the taxable income. And then we're going to subtract out the 12,000 standard or itemized deductions. Note that the interest is not a standard or itemized deduction. It's not an itemized deduction, in other words. And that means we get a benefit from it even if we're not itemizing. So that's why it's still a good thing to have. If we have student loan interest, we don't have to be itemizing in order to get the benefit for it. It's going to be what sometimes is called above the line deduction, or maybe now it's going to be called a Schedule 1 deduction, which is going to be an adjustment to income up here. So that means you're still going to get it even if you're not in the range of itemizing. And then we got the 12,000 bringing the taxable income to 17,400, tax at 1,901 in this example. Next example. During 2018, Joe paid 1,100 interest on her qualified student loan. Only she is legally obligated to make the payments. Joe's parents claim her as dependent on their 2018 tax return. In this case, neither Joe nor her parents may deduct the student loan Joe paid in 2018. So Joe can't take the deduction in this case because she's being claimed as the dependent on her parents' tax return, and we saw that that's going to be one of the restrictions for it. Back to the text. Interest paid by others. If you are the person legally obligated to make interest payments and someone else makes a payment of interest on your behalf, you are treated as receiving the payment from the other person and, in turn, paying the interest. So we can imagine a situation where we had interest paid and then someone else is going to make the payment for us. Possibly someone related to us or something like that is going to make the payment, and they make the payment directly to the bank. They write the check to the bank, make the payment. Well, what happens then? They can't take the benefit of the student loan interest because, of course, it's not their loan. They made a payment for our loan. So the code is basically saying, well, we will treat that as if the payment was made to the person making the loan and then the loan payment was made, as opposed to directly to the loan, because it's basically the same thing, right? They could have paid the person who had the loan, the taxpayer, who could have then paid the loan, and it would, in essence, be the same thing. So the tax code is basically saying we're going to treat it as if that was happening and therefore be able to take the deduction. Back to an example. Example 1. Darla obtained a qualified student loan to attend college. After Darla's graduation from college, she worked as an intern for a nonprofit organization. As part of the internship program, the nonprofit organization made interest payments on behalf of Darla. This payment was treated as additional compensation and reported on her Form W-2 Box 1. Assuming all other qualifications are met, Darla can deduct this payment of interest on her tax return. So she got paid, and it got paid this time by the employer. Note what happened though. It got paid by the employer, and then it got included in the W-2 Box 1, meaning it was part of compensation. So it's going to be included in income because it's part of compensation being included in Box 1, and therefore she's going to pay taxes on it. In other words, it's going to increase. In other words, if we take a look at the form here, example form, it's going to increase line 1 for wages because her W-2 wages went up by the amount that was paid, because the employer paying off the loan is, of course, a form of compensation typically. So it would be increasing here, but also would be getting the deduction because we're going to treat that payment as if it was made to Darla, and then Darla made the payments, when in actuality it was withheld from the paycheck most likely and then paid directly to the institution. So that's going to mean that we still get something like this deduction. We didn't see the dollar amount. Deduction still there, and in this case it would be payment that was earned income that was paid directly to the third party, including the income then being included in line 1. Back to the text, example 2. Ethan obtained a qualified student loan to attend college. After graduating from college, the first monthly payment on his loan was due in December. As a gift, Ethan's mother made this payment for him. No one is claiming Ethan as a dependent on his or her tax return. Assuming all other qualifications are met, Ethan can deduct this payment of interest on his tax return. So in this case, we have a similar situation. But now we have Ethan's mother making the payment. So Ethan's mother made the payment for the loan payment. And In this case, it's a little different, note, because obviously if his mother made the payment, it's not going to be income. It's not going to be something that's going to be included in line 1 as income as it was in the employer situation where it was included. Even in that case, however, it's still treated as if the mother, in essence, gave the money to the taxpayer and then the taxpayer made it. Why is that okay? Well, if it was paid to the taxpayer, it looks like a gift, and it's okay. The gift is okay. Gifts don't have to be included in income. So the assumption there would be, well, the money was gifted to the taxpayer and then paid. If it was something from the employer paying the employee, well, then you can't really have that gift situation because the IRS wants someone to pay tax. It looks like compensation. So if the employer pays it in some way, then typically it would have to be compensation included in line 1, and then the deduction still being there. If it's some like a relative or something like that, well, then the assumption would be, in essence, that it was a gift to the taxpayer, and then they paid the tax with it, and therefore get the deduction for it. Back to the text. No double benefit allowed. You can't deduct as interest on a student loan any amount that is an allowable deduction under any other provision of the tax law. For example, home mortgage interest. So in this case, we can't get two benefits from the same payment. So if we have some type of deduction with relation to the interest payments, we can't take two deductions. We can't double up on the deductions. In this presentation, we will discuss how to figure the student loan interest deduction. This information can be found in publication 970. Your student loan interest deduction is generally the smaller of $2,500 or the interest paid during the tax year. So that's going to be our limitation, in essence, a cap, the interest that we paid. Remember, we're not talking about the principal portion of the loan. It doesn't mean how much money we paid back for the loan itself, but the interest portion, and the interest portion then being capped at that $2,500 or at the amount allocated to interest of the payments that we are made. Remember that this information will usually be reported to us on a 1098-E. So we'll usually have this information and then can use it to generate or fill out our tax return. Not necessarily the case that we'll have that information with a 1098-E in all cases, but typically we will. Back to the text. However, the amount determined above may be phased out, gradually reduced, or eliminated based on your filing status and MAGI, which is the modified adjusted gross income. So if we take a look at a test 1040, we have our test 1040. If we consider the adjusted gross income, in this case, it would be on line 7. But there's going to be a modification. Modified adjusted gross income means we're going to modify it for something specific to this particular item, the interest deduction. Back to the text. As explained below, you can use worksheet 4.1 at the end of the chapter to figure both your modified adjusted gross income and your deduction. Form 1098-E. To help you figure your student loan interest deduction, you should receive a Form 1098-E student loan interest statement. Generally, an institution such as a bank or government agency that receives interest payments of $600 or more during 2018 on one or more qualified student loans must send a Form 1098-E. So note here we have a limitation that you want to be aware of. It sometimes helps to think how this stuff works, of course, and note that the institution, the bank or the government agency that's receiving the loan payments, so they're getting the payments from the student, the taxpayer, then is required to file the Form 1098-E in many situations. But of course, they would rather not, because it's more paperwork for them to do. The reason they're required to do it is through regulation. So the IRS, the government, has no more leverage with them to require them to report certain things. And therefore, they're going to do it if required. Note the requirement is if there are 600 or more payments during 2018. So that received interest payments of 600 or more during 2018, meaning if there could be a situation where it was less than the 600 and therefore there was no form that was filed. And that means there might be a situation where we have a deduction we could have that could benefit us for which we won't receive the Form 1098 for, and we want to just be aware that that situation could be the case. Back to the text, to each borrower by January 31st, 2019. So note that if you have loan payments, you should receive the document 1098E by January 31st following the tax year, in our case 2018, therefore January 31st, 2019. If you don't get it by that time, then you may want to contact the institution and see if you're in one of those cases where maybe they don't provide it or not required to do so, and then think about how you can go from that point forward. Back to the text. For qualified student loans taken out before September 1st, 2014, or 2004, not 2014, 2004, the institution is required to include on Form 1098E only payments of stated interest. Other interest payments, such as certain loan organization fees and capitalized interest, may not appear on your form you receive. However, if you pay qualifying interest that isn't included on Form 1098E, you can also deduct those amounts. So in other words, the 1098E we're hoping includes all the information at this point in time, and there could be information other than just the simple interest, which could include organization fees and capitalized interest. So at this point in time, we're hoping that information is on the Form 1098E, but if it's not, we might have situations where we have more than just the simple interest that could possibly be deductible. So we could see allocating payments between interest and principals for more information regarding that. Back to the text. The lender may ask for a completed Form W-9S or similar statement to obtain the borrower's name, address, and taxpayer identification number. The form may also be used by the borrower to certify that the student loan was incurred solely to pay the qualified education expenses. So notice they got to have the information for us to provide the documentation, including the 1098. And that means, so that's a Form W-9 that might have to be filled out by the borrower. In essence, usually the taxpayer we're talking about here. And that information has all the required information. So they have all your life information on it, right? Your name, your address, and the identification number, possibly social security number, so that they can then report this information to you and probably to the IRS as well. And so they need that information. If they don't have it, then of course we would need to provide it to them if there's any changes for it, including something like the address. Then we want to make sure that it's updated. We might be able to get this information electronically in some cases as well. Quick look at the Form 1040 and our Test 1040. We have our simple single individual. Just note, remember that if we had income up top, we have the $30,000 of income up top, and we have a qualified student loan interest, just the interest portion would be deductible, typically given to us on that 1098E. It's going to be on Schedule 1. So Schedule 1's new for 2018. So just remember, this is where like the above the line deductions go, the deductions that anybody gets. So this is one of those deductions we don't need to itemize in order to get. That's going to be one of the benefits of it. Down here on line 33, so here's 33. You could take a look at the worksheet that includes some phase out type information on it. If we close this back out, that then pulls to the 1040. If we go up top, so we had 30,000 in income this case. We had that amount, the 600, bringing the adjusted gross income to the 29,400. And that's one of the kind of the issues with the adjusted gross income, because typically when we look at the income limitation, we look at the AGI, and they said it was a modified AGI. Well, the funny thing about this one, of course, is that the deduction that we're including is going to be adjusting the AGI amount. It's an above the line deduction. So whenever we use the AGI, the adjusted gross income, to think about an income limitation of some deduction that then is going to affect the adjusted gross income, we usually have to do something, possibly taking that adjustment out when we're considering what the adjustment is. So that's one of the reasons we could have a modification to the adjusted gross income. But just remember, as income goes up, then of course we could start to phase out and lose the part of the deduction. And we'll take a look at more examples of that in future presentations. So we also said that there's a cap here. Note that there's an income limitation we'll take a look at in the future. We also said that this can be capped at $2,500. So if we paid $600, we got the $600. What if we paid like $3,000? Well, if I put $3,000 into the input screen, and again, tax software kind of helps because it mirrors the code. So if we look at tax software, we can kind of test what's happening in the code, and we could say, oh, I mean, that lines up, that makes sense typically. So then we're going to say, well, 3,000. Well, what'll happen? If I go to the form, back to the form, it caps it at 2,500. Why? Well, if we go into our worksheet here, we've got the 2,500 capped. And line 1 says total qualified student loan interest paid not more than 2,500. So that's going to be our limitation. Now, next we'll see in this worksheet, we see some references to 65,000 and 135,000 if married filing joint. That looks like an income limitation, a phase-out limitation. So our first cap then, we're thinking about we can't get more. This is just interest. Note, this doesn't mean that your payments weren't more than this, because the principal portion isn't what we're talking about. It's just the interest portion. So the interest portion would have to be 2,500 or less, or will be capped at the 2,500. The actual payments you made for the loans will be definitely much more than that if you had just an interest portion of the 2,500. Now, this amount, of course, on the Schedule 1 is flowing through, as we saw, to the 1040. So now it's going to be the difference between the 30,000 taxable income and the adjusted gross income, 27,500. We have a standard deduction in this case of the 12,000, and then the taxable income down to 15,500. Note that this amount deducted, once again, isn't part of that standard deduction or the itemized deductions. We get it even if we can't itemize, and we still get the standard deduction, which is nice. Then we have the tax calculated on it. Now, if we want to see the effect of this, it's kind of nice. We can go to, I'm going to go to a summary type view and say, well, what would happen in summary if I go down and I say that here's basically the tax. I'm not going to deal with the interest. We have this tax owed, and we could see up top that we had this adjustment of the 2,500. That's going to adjust the income from 30 to 27. Well, the tax is at 1,673. The rate's marginal tax rate of 12, effective tax rate of 10.8%. That's going to be like the average tax rate and the highest marginal tax rate at this point. Well, what if we took this out then? You could say, all right, well, what if we took the 3,000 away and we went back here? Well, it changes to 1,973. So with tax software, you can kind of see the effect. Notice we're not talking about a credit here. We're talking about a deduction, the deduction lowering income. So the 2,500 deduction, if we take a look at our calculator here, 1973. If we go back in and we say 2,500, because that's the cap, and then we go back over and take a look at our change now and say, all right, minus the 1,673, that's a benefit of $300. So $300 is the change, the tax benefit of the deduction. If I divide that by the 2,500, we get 12, right? Because that's the marginal tax rate or the highest tax rate kind of benefit. So the benefit is in relation, in essence, to the tax rates. And usually the marginal tax rate is the highest tax rate that you're at. So when you start to take deductions, then it's going to start peeling off on the highest rate. So if you have more income from this point, then it could increase your tax at 12%, even though the average is 10%. If we get more deductions, we're going to start peeling off benefits at the greater 12% rather than the average 10% until we go below to the next tax bracket. In this presentation, we will take a look at the effect of the amount of your income on the amount of your student loan interest deduction. In other words, we'll take a look at the phase out as the income goes up. So as our income increases, what happens to the amount of the student loan interest which we can take? Back to the text. Effect of the amount of your income on the amount of your deduction. The amount of your student loan interest deduction is phased out, gradually reduced, if your MAGI, modified adjusted gross income, is between $65,000 and $80,000, $135,000 or $165,000 if you are married filing joint. So in other words, we have this range. The range is going to be higher for the married filing joint. If we're not married filing joint, meaning typically head of household or single, will typically have the lower range here. And back to the text. The denominator bottom part is 15,000, 30,000 in the case of joint return. Subtract the result from your deduction before the phase out to give you the amount you can deduct. So if we're within this range, then we're going to take the student loan interest we have and we're going to have to phase it out in some way. And so we'll first take a look at what is going to be the effect as we get to these limitations, as we get to the max of these limitations. We want to know when these limitations will affect different taxpayers or us. If we're single, of course, it'll start to take effect at 65, and then we'll lose it completely. So if our income is above the 80, we'll lose it completely. If we're married, filing joint, 135 to 165. Let's take a look at an example where we had the income in our test 1040. Here is our test 1040. As we scroll through it, we have the 30,000 of income. We're taking the deduction here. We could see because line 6 and line 7 aren't the same. We have 30,000 and 27,005. The difference being on Schedule 1. Schedule 1, scrolling down, there's the 2,500. What if then we increased our income closer to that cap? Let's put it at the 66,000. So this is a single filer, so therefore let's say, what if the income was 66,000? And go back and say, what happens to our information? Of course, on 1040, we'll see the 66,000 here in income. That difference, the 66 and the 63, 668 is given by the Schedule 1, which is the amount of our deduction now being limited to 2,333. If we look at our worksheet, we could start to look at what the phase out is doing here. We'll get into a little bit more detail on that in another example. But just to get a feel for the phase out, notice we're at 66 now. It's going to phase out at 80,000. So if we go back over and say, all right, well, what if this was 70,000, let's say, and we had remember that we had a 2,500 qualified. Now we're at 1,667 of the qualified 2,500. We'll get back into this a little bit later. And so now we can say, well, what would happen if we were at 75,000? We're getting close to the cap. Remember, it is 80. Now we're at 832. And then if we could say, well, what if we were at, say, 78,000? Then we have 332. According to the tax software here, we're relying on the tax software, 80,000. 80,000. And that brings this down, and notice it disappears entirely. We no longer see the schedule in this software, and we no longer have the deduction. Of course, if we were married, however, if we went from single to married, and we had that same amount of income, the 80,000, well, then the deduction reappears because now we have the higher income limitation. So if we go back to Schedule 1, and we see the 80,000, now it's back up to the 2,005. We're not even at the lower threshold. So notice we could go all the way up if we're married to, let's say, 134,000, and go back over and say, all right, we have 134. It's still maxed out, right? We haven't even hit the lower limit there. Still showing the difference, still here. Now, if we get to 135 is where the lower limit is. If we go to 136,000 and go back over, okay, 136 starts to limit our deduction, right? And we get the same type of activity now at this point. If we say 140,000, so we're gonna go back over and say 140 now. We're limiting. If we get it's at 165 is the top. So if I say 160,000 and go back over 160,000, it's going pretty close. If we say 164,000 and say what does that do? We're at now just 82. And of course, once we hit that 165, then we should be gone. It should be gone. So there it is. No more. It is no more. Back to the text. So here's an example. During 2018, you paid $800 interest on qualified student loan. Your 2018 modified adjusted gross income is $150,000, and you are filing a joint return. You must reduce your deduction by $400, figured as follows. So we'll take a look at that. Let's put that into the software, and then we'll take a look at the formula for the calculation of it. So here we are in the software, married filing joint in our test 1040. If we scroll down, we're going to say that we have the 150,000. So that's going to be above the lower limit, but not to the upper limit yet. We see that the deduction is being taken on Schedule 1, and Schedule 1 is only at 400, however, when we entered 800. So we entered 800 qualified, only 400. Let's take a look at the calculation with regards to the worksheet. We say that the total qualified student loan interest paid not more than $2,500. So we paid $800, which is less than the $2,500. So that's line 1. Line 2, into the amount from 1040 line 6, 150,000. That's going to be our income. So the 150,000. Line 3, add amounts from Schedule 1, lines 23 through 32, and any amount entered on the line next to Schedule 1, line 36, other paid DPAD. So these are going to be adjustments. We don't have any in our case here. Number 4, subtract line 3 from line 2. So we're still at that 150,000. That in essence now being our modified adjusted gross income. Number 5, enter 65,000 or 135,000 if married filing joint. We're at married filing joint. These then are going to be the lower limits. So we've got the 150,000 and then we've got the lower limit of the 135 for married filing joint. Line 6 says, is the amount on line 4 more than the amount on line 5? If no, skip line 6 and 7, enter 0 on line 8 and go to line 9. If yes, subtract line 5 from line 4. So that's what we'll do here and get the 15,000. And then line 7 says divide line 6 by 15,000. 30,000 if married filing joint. We of course are the 30,000, so we're dividing line 6 up top being the 15 over the 30, which of course gives us that 50% or 0.5. Multiply line 1 by line 7, meaning our amount of interest, the 800, times the 0.5, which will give us half, 4. And then number 9 says student loan interest deduction, subtract line 8 from line 1. So now we're going to take line 8, subtract the 400, which is half of it, to get to the 400. So that's going to be our worksheet. Let's take a look at it now in the formula basis of it. So if we think about just the formula, we could see the same kind of calculation in the linear kind of format, one step at a time within the worksheet. So if we have it here, it's going to be 800 times 150, which of course was our income, minus the 135, the lower limit, divided by 30,000, amount just basically given as the married filing joint amount, and that equals the 400. So the 400, so your reduced student loan interest is 400, which is the 800 minus that 400. So we can see it in this formula format. Same formula, of course, in the worksheet, but when we do a worksheet, we do it in a up and down column type format. And we have to do it one step at a time. So of course you can see those two formats, whichever way makes the best sense in your mind. It's good to see them both ways, however, because when you look at the code or something like that, it'll be listed this way. When you go to the actual tax software to try to figure out how to put this into the software, it will of course be listed in a column type format. Next example. The facts are the same as in example 1, except that you paid $2,750 interest. Your maximum deduction for 2018 is $2,500. You must reduce your maximum deduction by $1,250, figured as follows. So now we're going to enter in the system the $2,750. And then we're going to go back up and say, all right, but that caps it at the $1,250. The $1,250 is the amount of the deduction that's being calculated by the system. Two things are happening, or we can think about two things happening. One is we have the income limitation similar to what we had last time. 150,000 is our income for the married filing joint. And 2, we paid interest over that 2,500 amount. So let's consider those in our worksheet then. So if we say the total qualified student loan interest paid not more than 2,500. So that is the new thing. That's our first limit that we had. So we paid 2,750, but we're limited to 2,500, which we then have to use to calculate any kind of phase out. So then we enter the amount on 1040, our income. Then when we add the amounts from Schedule 1, and these are the adjustments, we don't have any. So 150,000, and then we subtract, and so we're back at the 150, and then enter 65,000 or 135. We're at the 135, married filing joint. Is the amount on line 4 more than line 5? If no, skip. If yes, then subtract line 4 from 5. That's what we do here. We've got 15,000, and then divide line 6 by 15,000. 30,000 if married filing joint. We are married filing joint. So we're using the 30,000, and that's going to give us that 0.5, and then multiply line 1 by line 7, which is 1,250. And finally, student loan interest deduction, subtract line 8 from line 1. So we'll subtract this from that. We get the 1,250. So that's going to be our limit. Major difference here just being that now, if we paid more student interest than $2,500, we start our calculation at that $2,500. So in the terms of a formula, it would be $2,500 times $150,000 minus $135,000 divided by the $30,000. So this being our income minus the lower limit divided by $30,000 for married, filing, joint gives us that $1,250. In this example, your reduced student loan interest deduction is $1,250 or $2,500 minus that $1,250. In this presentation, we will discuss student loan interest defined as it relates to student loan interest deduction. This information can be found in publication 970. Student loan interest defined. Student loan interest is interest you paid during the year on a qualified student loan. It includes both required and voluntary interest payments. Qualified student loan. This is a loan you took out solely to pay qualified education expenses defined later that were for you, your spouse, or a person who was your dependent as defined later for this purpose when you took out the loan, paid or incurred within a reasonable period of time before or after you took out the loan, and for education provided during an academic period for an eligible student. Let's run through that again. This is a loan you took out solely to pay qualified education expenses. So we have that key term, qualified education expenses for you, your spouse, or person who was your dependent. So that's going to be someone that is on the actual tax return, of course. If we're thinking about taking the deduction, then typically, usually, we would need that information on the tax return or that person indicated on the tax return, that being either us, our spouse, or the dependents on the tax return, paid or incurred within a reasonable period of time before or after you took out the loan, meaning the loan that was taken out was paid or incurred within a reasonable amount of time for the qualified education expenses, because that's why there's going to be a benefit for this, because the purpose of the loan was for the education expenses, and therefore the interest related to it when we repay the loan is possibly something that we can get a benefit from through a deduction. Lastly, the education provided during an academic period for an eligible student. So we have to have an eligible student, another key term there, eligible student. Back to the text. Loans from the following sources aren't qualified student loans. So these are going to be specifically excluded, not included as the qualified student loans. A related person. So if someone just loans us money, then the interest on that loan, just an individual person, typically will not qualify. And note that most loans, most typical type of student loans, will oftentimes provide us a statement that will let us know the interest portion and more likely indicate that the interest would then be something that possibly could be deductible if qualified. But if we took out a loan from a friend, for example, for our education, and we had to pay back that loan plus the interest, typically that would not be something that would apply or be able to be deductible, the interest on the repayment of that loan, even if you use the funds for education. Next, a qualified employer plan. A qualified employer plan not being a qualified student loan. Your dependent, generally your dependent is someone who is either a qualifying child or a qualifying relative. So if we take a look at our test 1040, we have our test 1040. The dependents will typically be down here. So it'll be someone that will be reported here, either a qualifying child or a qualifying relative. So when we are thinking about deducting the student loan interest, it would typically have to be someone on the return, some Social Security, somewhere on the return, husband, spouse, and or dependents would typically be those individuals. You can find more information about dependents in publication 501. So if you got more questions about what a dependent is or who qualifies as a dependent, you go to the irs.gov website and look for publication PUB 501. For this purpose, the term dependent also includes any person you could have claimed as a dependent on your tax return except that. So note here, we have an exception, we have the dependent rule, and then we have a specific exception that is specific to this circumstance. Let's read it one more time. For this purpose, the term dependent also includes any person you could have claimed as a dependent on your tax return except that You or your spouse, if filing jointly, could be claimed as a dependent of another taxpayer, like on your parents' tax return. The person filed a joint return, or the person had a gross income for the year that was equal to or more than $4,150 for 2018. So we're basically saying that it's anybody that's a dependent on the tax return and anybody that could have been a dependent but were just stopped from being a dependent by one of these three things. So one of these three things are one of the conditions to be a dependent. If that thing was what kept the individual from being a dependent on the return, that might qualify as an exception. Back to the text. Reasonable period of time. Qualified education expenses are treated as paid or incurred within a reasonable period of time before or after you take out the loan if they are paid with the proceeds of student loans that are part of a federal post-secondary education loan program. Even if not paid with the proceeds of that type of loan, the expenses are treated as paid or incurred within a reasonable period of time if both of the following requirements are met. First requirement, the expenses relate to a specific academic period. Second requirement, the loan proceeds are dispersed within a period that begins 90 days before the start of the academic period and ends 90 days after the end of that academic period. Let's break that down or read through that one more time. Note that most of the loans will be the federal post-secondary education loan types at this point in time, and therefore there's going to be more of a standardized process. That's going to be the first component here. The second component will be an item where there might be some deviation where we have the two variants. So let's read through it again with that in mind. Reasonable period of time. Qualified education expenses are treated as paid or incurred within a reasonable period of time before or after you take out the loan if they are paid with the proceeds of student loans that are part of the federal post-secondary education loan program. So that's going to be factor number one, probably the most likely factor. Second item, even if not paid with the proceeds of that type of loan, so even if they were not taking that kind of normal standard type of loan, the expenses are treated as paid or incurred within a reasonable period of time if both the following requirements are true. Two requirements, both, not or, must be met. The expenses relate to a specific academic period, so we have to have a specified academic period, and the loan proceeds are dispersed within a period that begins 90 days before the start of that academic period and 90 days after the end of that academic period. If neither of the above situation applies, the reasonable period of time usually is determined based on all the relevant facts and circumstances. Academic period. An academic period includes a semester, trimester, quarter, or other period of study such as a summer school session as reasonably determined by an educational institution. So this is one of those terms, the academic period. A lot of different schools can have a lot of different names for the academic period. So note what we have here, the basic standards. We're going to go to the institution, and as long as it's reasonably determined by that educational institution, then we should be good. The key term, of course, being reasonable, has to be reasonably determined. Back to the text. If an educational institution uses credit hours or clock hours and doesn't have academic terms, each payment period can be treated as an academic period. Eligible student. An eligible student is a student who was enrolled at least half-time in a program leading to a degree, certificate, or other recognized educational credential. Enrolled at least half-time. A student was enrolled at least half-time if the student was taking at least half the normal full-time workload for his or her course of study. The standard for what is half of the normal full-time workload is determined by each eligible educational institution. So once again, they might have different rules because of course the terms might be different, the terminology they use for the periods might be different, but it's going to be determined by the educational institution as what does it mean to be full-time? What does it mean to be a part-time student? Back to the text. However, the standard may not be lower than any of those established by the U.S. Department of Education under the Higher Education Act of 1965. A related person. You can't deduct interest on a loan you get from a related person. Related person includes your spouse, your brothers and sisters, your half-brothers and half-sisters, your ancestors, parents, grandparents, etc., your lineal descendants, children, grandchildren, and certain corporations, partnerships, trusts, and exempt organizations. So typically, again, most of the loans are probably going to be more formalized loans for most educational purposes, most educational loans, but it's quite possible, of course, to get a loan someplace else. If we get a loan from a related person, the IRS is often very skeptical of that and may not give any benefit for that. In this case, they're saying no benefit for this particular interest deduction because, of course, if someone's related, the IRS is going to be skeptical as to the trueness of the loan. Or that's my rationale as to why the law may be. But in any case, these are going to be excluded. So related person here, you can't deduct interest on a loan you get from a related person, typically for the education loan. Back to the text. Qualified employer plans, you can't deduct interest on a loan made under a qualified employer plan or under a contract purchased under such a plan. In this presentation, we will discuss the term of qualified education expenses as they relate to student loan interest deduction. This information can be found in publication 970. Qualified education expenses. For purposes of the student loan interest deduction, these expenses are the total costs of attending an eligible educational institution. They include amounts paid for the following items: tuition and fees, room and board, books, supplies, and equipment, other necessary expenses such as transportation. So note, as we think about these qualified education expenses for different types of educational benefits, they could slightly differ slightly, depending on the type of benefit that we are looking into. So remember that when you're looking into some of these terms within the tax code, that the term itself could be the same, but we're applying it to different types of things, different areas, and you want to make sure that the term you're looking at is being applied to the specific area that we are in. Within here, we may have various amounts of different types of education benefits. We might have similar terms as we apply to them. Want to make sure that you're considering the terminology being used as it's being applied to the current benefit in terms of the education benefits here. Back to the text. The cost of room and board qualifies only to the extent it isn't more than the allowance for room and board as determined by the eligible educational institution that was included in the cost of attendance for federal financial aid purposes for a particular academic period and living arrangements of the student, or if greater, the actual amount charged if the student is residing in housing owned or operated by the eligible education institution. So notice the room and board, they're saying is included, but there's going to be restrictions to the room and board. As we include room and board, you can see why the IRS might be a little bit more skeptical to include the room and board, because people might try to abuse the system by applying the loans to basically an excess of room and boards. So the cost of room and board qualifies only to the extent it isn't more than with these two conditions. Back to the text. Eligible educational institution. An eligible educational institution is generally any accredited public, non-profit, or proprietary, privately owned, profit-making college, university, vocational school, or other post-secondary educational institution. Also, the institution must be eligible to participate in a student aid program administered by the U.S. Department of Education. Virtually all accredited post-secondary institutions meet this definition. So that's really what you're looking for. You're looking at the accredited institutions. You can contact the institution. They should be required to give you, whether their accreditation. And if that's the case, then typically most accredited schools, they're saying here virtually all accredited post-secondary institutions meet this definition. So it's fairly broad in terms of schools which are accredited. Back to the text. An eligible educational institution also includes certain educational institutions located outside the United States that are eligible to participate in the U.S. Department of Education's Federal Student Aid, FSA, programs. The purposes of the student loan interest deduction and eligible educational institution also includes an institution conducting an internship or residency program leading to a degree or certificate from an institution or higher education, a hospital, or a health care facility that offers postgraduate training. An educational institution must meet the above criteria only during the academic periods for which the student loan was incurred. The deductibility of interest on the loan isn't affected by the institution's subsequent loss of eligibility. So in other words, if we were going to school and the school was accredited at the point in time we were going to it, and then we got a loan out and of course went to school, and then the school, something happened to the accreditation afterwards, but we already graduated and we've got our certificate and whatnot, or our degree, and so we're good, but now we're paying back the loan. Well, the fact that the institution no longer is accredited shouldn't affect the fact that the deductibility of the interest that we have on the student loans that we got when the school was accredited. Back to the text. The educational institution should be able to tell you if it is an eligible educational institution. So you should be able to contact the institution. They should be able to let you know that. They should be able to give you their credentials, in essence, as an educational institution. In this presentation, we will take a look at adjustments to qualified education expenses as they relate to student loan interest deduction. This information can be found in Publication 970. You must reduce your qualified education expenses by the total amount paid for them with the following tax-free items: employer-provided education assistance, tax-free distribution of earnings from a Coverdell Education Savings Account, an ESA, tax-free distribution of earnings from a qualified tuition program, a QTP, U.S. saving bond interest that you exclude from income because it is used to pay qualified education expenses, the tax-free part of scholarship and fellowship grants, veterans educational assistance, and any other non-taxable tax-free payments other than gifts or inheritance received as educational assistance. So note, most of these, of course, when we're talking about qualified educational expenses, we're saying if the educational expense for many of these items was not something that was included in income, then although, of course, it was paid for an expense for school, it's not a qualified education expense in essence because we weren't able to we didn't record the income on it, and therefore the benefit that's going to be received from it, we shouldn't have a benefit or a deduction if we didn't have the income of these items that would be included. For example, if we had the tax-free scholarship and fellowship, then of course we would have gotten money. That money would have gone to the education, but we kind of basically got income that we didn't have to record on the tax return as income, and therefore we got a benefit from it. It's kind of the same thing as if we put it on there as income and then got a deduction for it. And so that's why it's not going to be a qualified education expenses. That's me paraphrasing the reason for many of these items not being a qualified education expenses, because there's already been a benefit for these items, most of these items, in some way or another, including for many of them not having the income that was received included in income and paying income tax on that item. In this presentation, we will take a look at the term include as interest as it relates to student loan interest deduction. This information can be found in Publication 970. Include as interest. In addition to simple interest on the loan, if all other requirements are met, the items discussed below can be student loan interest. So of course, that's the benefit we're looking for. We're looking for it to be student loan interest, because the higher the student loan interest that we can qualify for, then possibly we can get the deduction for it. So again, of course, we don't want to have a high student loan interest because we don't want to be paying high interest, but whatever interest we pay, we want to be able to include it as something that possibly can be deductible for student loan interest. Back to the text. Loan orientation fees. In general, this is a one-time fee charged by the lender when the loan is made. So that's the orientation fee, obviously the origination fee, or we can think of it as the terminology indicates, the orientation fee or the origination fee. That's going to be the one-time charge for the lender when the loan is made. Back to the text. To be deductible as interest, a loan orientation fee must be for the use of money rather than for property or services such as commitment fees or processing costs provided by the lender. A loan orientation fee treated as interest accrues over the life of the loan. Loan orientation fees weren't required to be reported on Form 1098-E, Student Loan Interest Statement, for loans made before September 1st, 2004. If loan orientation fees aren't included in the amount reported on Form 1098-E, you can use any reasonable method to allocate the loan orientation fees over the term of the loan. In other words, we're hoping that the 1098-E, so the 1098 is going to be the form that we would typically be receiving that would be recording the student loan interest. We're going to get the 1098-E, and that will be used to help us complete our tax return. We're hoping that in the case that we have the orientation fees, it would be included in the 1098-E. If for some reason it's not, then of course we would have to use any reasonable method to allocate the loan orientation fee over the term of the loan. Back to the text. Capitalized interest. This is unpaid interest on a student loan that is added by the lender to the outstanding principal balance of the loan. Capitalized interest is treated as interest for tax purposes and is deductible as payments of principal are made on the loan. No deduction for capitalized interest is allowed in a year in which no loan payments were made. Interest on revolving lines of credit. This interest, which includes interest on credit card debt, is student loan interest if the borrower uses the line of credit card, only to pay qualified education expenses. Interest on refinanced and consolidated student loans. This includes interest on a loan used solely to refinance a qualified student loan of the same borrower. It also includes a single consolidated loan used solely to refinance two or more qualified student loans of the same borrower. In this presentation, we will discuss allocating payments between interest and principals as it relates to student loan interest deduction. This information can be found in Publication 970. Allocating payments between interest and principal portion. The allocation of payments between interest and principal for tax purposes might not be the same as the allocation shown on Form 1098-E. So we're going to receive the Form 1098-E. You would think, hopefully, that the 1098-E would be what we can use to put the information directly into the tax return. But the allocation shown on 1098-E may not be the same as the allocation between interest and principal. Back to the text. Or other statement you receive from the lender or loan servicer. To make the allocation for tax purposes, a payment generally applies first to the stated interest that remains unpaid as of the date the payment is due, second to any loan orientation fee allocable to the payment, third to any capitalized interest that remains unpaid as of the date the payment is due, and fourth to the outstanding principal. So this is going to be the allocation of the payments, the order in which the payments should be allocated. Back to the text. Example. On August 2017, Peg took out a $10,000 student loan to pay for the tuition for her senior year of college. The lender charged 3% loan orientation fee, which is $300, that was withheld from the funds Peg received. The interest, 5% simple interest, on the loan accrued while she completed her senior year and 6 months after she graduated. At the end of that period, the lender determined the amount to be repaid by capitalizing all accrued but unpaid interest, $625 interest accrued from August 2017 through October 2018, and adding it to the outstanding principal balance of the loan. The loan is payable over 60 months, with payment of $200.51 due on the first of each month beginning November 2018. Peg didn't receive a Form 1098-E, so she didn't get her 1098-E for 2018 from her lender because the amount of interest she paid didn't require the lender to issue the information on information return. So in this case, wasn't required by the lender, and of course if it's not required by the lender, they may not issue it because it's not something that's profit generating for them to do. So they only do that if they're forced to do so by the regulations typically, and usually the IRS has pressure on the lenders or the people that are receiving the payments, the bigger companies, because they have more pressure to put in regulations on them. So if that regulation isn't there, if they don't have the pressure, in other words, to issue the 1098, they may not do so. So back to the text. However, she did receive an account statement from the lender that showed the following 2018 payment on her outstanding loan of $10,625. She had $10,000 principal, $625 accrued interest, but unpaid interest. So here we have the breakout: payment due, payment, stated interest, and principal. So we've got the payments that have been made, the stated interest amounts, and the principal amounts. So we can see as the payments are made, of course, the payments are the same in amount. So we made the loan payments that are going to be the same, and then we have to break them out between interest and principal. It's not easy to do that all the times, because by making the payment amounts the same, then the things that change is the amount of allocation between interest and principal. So you'll see that the first and second payment, although the payment was the same, the amount of stated interest and the stated principal will differ. So it's a little bit tricky to add this stuff up, because we're only looking at the interest portion as something that could be deductible. The repayment of the loan isn't the thing we're considering that might be deductible. We're looking for that interest on it. Back to the text. To determine the amount of interest that could be deducted on the loan for 2018, Peg starts with the total amount of stated interest she paid, $87.89. She allocates the loan orientation fee over the term of the loan. That's going to be $300 divided by 60 months, or $5 per month. A total of $5 of each of the two principal payments should be treated as interest for tax purposes. Peg then applies the unpaid capitalized interest, $625, to the two principal payments in the order in which they were made, and determines that the remaining amount of principal of both payments is treated as interest for tax purposes. Assuming that Peg qualifies to claim the student loan interest deduction, she can deduct $401. So we've got the $87.89. That of course is the interest here, plus the $10 plus the $303.13. Back to the text. For 2019, Peg will continue to allocate $5 of the loan origination fee to the principal portion of each monthly payment she makes, and treat that amount as interest for tax purposes. She also will apply the remaining amount of the capitalized interest to the principal payment in the order in which they made until the balance is zero, and treat those amounts as interest for tax purposes. So if we see this in our test 1040, this is just the test 1040. The names won't be the same. We'll just look at a similar situation here where we have the simple single individual. As we scroll through this, we got the $30,000 of income. We've got the $29,599 as the adjusted gross income. And note there's a difference there. What is that difference due to? Well, we're going to go over to the Schedule 1. Schedule 1 is where that difference will be down here on line 33. Which will be the 401 student loan interest deduction. So that's where it's going to go basically on the tax form. If we take that 401 and go back to the 1040, then we're going to scroll down and say that's going to be the difference between the total income and the adjusted gross income. We've got our standard deduction of the $12,000, and then the taxable income, $17,599, tax at $1,919. In this presentation, we will take a look at items that we don't include as interest with relation to the student loan interest deduction. This information can be found in Publication 970. Don't include as interest. You can't claim a student loan interest deduction for any of the following items. Interest you paid on a student loan if, under the terms of the loan, you aren't legally obligated to make interest payments. So obviously if you're not required to make the interest payments, and for whatever reason you choose to make the interest payments, then that wouldn't be something that would be deductible. So it had to be something, of course, the interest normally would be required to be paid as part of the terms of the loan. Loan orientation fees that are payments for property or services provided by the lender, such as commitment fees or processing costs. Interest you paid on a loan to extend to the extent payments were made through your participation in the National Health Service Corps Loan Repayment Program, the NHSC Loan Repayment Program, or certain other loan repayment assistance programs. For more information, see Student Loan Repayment Assistance. So if we get loan payment assistance, then of course the idea being that we already got a benefit from the loan payment assistance and therefore shouldn't get, it would be kind of like a double up possibly. This is my interpretation of why the law may be here. It might be considered a double up in terms of benefits, and therefore we have the restriction there to include the interest as a deduction. Back to the text. When must interest be paid? You can deduct all interest you paid during the year on your student loan, including voluntary payments until the loan is paid off. In other words, we're typically on more of a cash basis here when we're thinking about the amount of the interest that we can deduct with relation to student loan interest. It's typically going to be the interest that we actually paid within the current year on more of a cash basis, meaning did we pay the interest, not necessarily the interest in accruing. It has to be the actual payment of the interest. That would be the typical portion that we could then possibly use as a student loan interest deduction.